Cash flow is one of the most important information that a financial management needs to make managerial decisions. And the problem is that cash flow and information that a financial manager needs, they are not really directly reported in financial statements of the company. So although there is a statement of cash flows and you can find in the financial statements, but that one is different from what I mean. So for cash flow, we mean we want to know, for example, how much cash came into the company and how much went out of the company. This is very important. For example, the owner of the company may want to know in a given year how much cash he took out of the business, right? So we will look at how cash is generated from utilizing assets and how it is paid to those who financed purchasing the assets. Remember, for balance sheet, there were two columns, right? The left side was assets and the right side was how to finance, how we paid for these assets. And it had two components. The first one was liability or debt, and the second one was shareholders' equity. So we want to use the same concept here. So we can write now this formula from the one that you already saw, the balance sheet identity. So it's cash flow from assets, means the company already owns some assets, maybe machinery, building, trucks, whatever, all assets that they have. They are using in the company to generate revenue, right? To generate cash. So the cash flow that is generated from assets, this equals to cash flow that we pay to the creditors and the cash flow that we pay to, that goes to shareholders. So this is exactly what you saw in balance sheet. Assets equals to liability plus shareholders' equity. So cash flow that is generated from assets, because those, the right side of the right column of balance sheet means shows that how we paid for these assets, right? Now, when we generate revenue, when we have some cash, we need to return it to those who finance these assets, right? So the cash flow that is generated from assets will go to the creditors, means those who provided loan to the company, who lent money to the company, and to shareholders who put their money in the company, the owners of the company. So very easy to memorize this, right? Because I expect you to memorize the balance sheet identity, means assets equals debt or liability plus shareholders' equity. So it's the same thing. But I just want to make sure you understand, because if you understand, then easy to answer the questions. So the cash flow is generated from using the assets in the business, and this cash flow that is generated will be paid to the two main sources of finance, means those who lent money to the firm and those who put their money into the business for the firm, means their shareholders. And there is another formula, there is another way to compute the cash flow from assets. Cash flow from assets equals operating cash flow, means the cash flow that is generated by the business minus by the operation of the business, minus net capital spending, minus changes in net working capital. What does it mean? Again, I really want you to think about them and understand these formulas. Later I will show there are so many formulas for this topic. So it's good if you understand them. It will make life easier. So cash flow from assets. What is cash flow from? Means cash flow from assets is free cash flow, right? It means the cash flow that we can pay to, we remember from the previous slide, we can pay to the creditors, means those who lent money to the firm, and to shareholders, means those who are the owners of the firm, put their money into the business for the firm. Now, this cash flow from assets or free cash flow can be computed by operating cash flow, means the cash flow that is generated from operation of the company, minus. Why minus? Because we already have generated some cash flow. Now we have to perhaps, for in some cases, we want to spend on fixed assets. So net capital spending means how much you spend on fixed assets of the firm. So part of the cash flow that's generated from the operation business of the company will be spent on capital spending. Net capital spending means how much you want to the difference, how much, later we will explain more, how much will go to fixed assets. And changes in net working capital. You remember, net working capital is the difference between current assets and current liabilities. So it's about the short-term part. So net capital spending is about the long-term part, fixed assets, how much you want to spend on fixed asset. Then changes in net working capital means how much you want to put in your net working capital, right? Means about the day-to-day business of the firm. And what is left is free cash flow. It will be paid to creditors and shareholders. And yeah, as you can see here, actually explanation already is here. Money spent on fixed asset is capital spending, and a firm also investing in current assets. So investing in current assets means how much you want to spend on net working capital. So yeah, easy to understand. And here you can see all formulas that you need to answer this question. So we want to compute the cash flows, for example, to credit. We may want to compute the cash flows to creditors, to stockholders, cash flow from assets. So there are different formulas to compute them, because these information, as I said, are not provided in financial statements of the company, and they are the most important information that you need for managerial decisions. So cash flow identity is the first one that we discussed, right? Then this one also I explained to you. And here, as you can see, for example, operating cash flow is earning before interest and tax, and you can find this in net income statement, and depreciation and taxes also in net income statement, and then net capital spending, end of the year net fixed assets minus the beginning net fixed asset plus depreciation. So you can find this information mostly in balance sheet and an income statement. So you need to have your balance sheet and income statement, and then check where you can find this information, then put in the formula and compute. But the logic behind it, I think I could explain it to you. And here you can see cash flow to creditors. Cash flow to creditors, this one. Cash flow to creditors, what is this? Means how much, it means the net amount that goes out to those who lend money to you, right? And it's very easy to understand. Interest paid. You already borrowed some money. You have to pay back interest, right? You got a loan, you have to pay back interest. So the cash flow that goes to people who gave loan to the company means the interest that you have to pay back minus net new borrowing. You see, it's like this. Okay, here is the company, and here is the creditors, means those who provided loan to the company, those who are lending money to the company. So here we have company, here is the creditors. Now, how to compute cash flow to creditors? The money that goes from company, the cash flow that goes from company to the creditors is interest rate that we paid to the creditors, and at the same time, the company may receive new loans as well, right? So at the same time, they are paying interest on previous loans, and they may receive new loans as well. So it's interest paid minus net new borrowing. And cash flow to stockholders. Again, okay, let me use pen. Suppose this is the company and these are the shareholders, right? So cash flow to stockholders or shareholders means the company, this is the company. The company will pay dividend to the shareholders. So it goes in this way. And then the company may issue new shares, and this means more money from the owners. They will buy the shares, and more money will come to the company. So Dividends paid is going out of the company, and the money that comes from issuing new shares that come in is net new equity raised. So dividend paid minus net new equity raised is cash flow to stockholders. So this is the logic behind it. So you need to think about it, and you need to work with these formulas to be very comfortable with them. Actually, it's like a puzzle. When I give you a question, I may give you some of these information. Then you may need to put the information here in this formula, and then find this one, then put this one in the next one, and then the next one in the next one to find what you are required. So you need to use all maybe to answer one question. And you need to practice to be comfortable with it.